So, we are starting our discussion of pilot paper, FRG pilot paper, and I suppose you would have watched all our previous videos of the webinar series, and I am not discussing the questions in the exact order in which the questions are given in the paper, but if I were a student, which question would I start from? As I say before repetitively, as I said before, remember you do not have the second chance to make the first impression to the examiner. You must start with the questions that you are confident the most, the questions that you can impress the examiner the most. If you feel that is the MCQ questions, you better start from MCQ questions. If you feel that the questions that you can impress the examiner the most is the console question, you should start from the console questions, and there is no hard and fast rule, and you must do what you think is good. What you think is good for you, what you think you are good, what you think is good for you. So, now let me just skip the MCQs for a moment, not that we are going to skip them, we will take them in our discussions in a little while, but let me go to the other sections first. We will go to section 2, question number 2, section 2, question number 2. Part A, Tesla Energy Private Limited is a rooftop solar installer, an importer of solar related products. It prepares its financial statements in accordance with SLFRS for SMEs. The operating results of the entity have deteriorated for 2 consecutive years, including the year ended 31st March 19. Presently, the entity is facing a challenging time in business operations. As a result, going concern issues are noted. A director has inquired the accountant of TE whether any issue on going concern should be disclosed even though the entity prepares its financial statements in accordance with SLFRS for SMEs. Required. Advised the director regarding the going concern disclosure in accordance with SLFRS for SMEs. Now, let me highlight something which I have not spoken about before. Please, one reason why you can't score the way you need to score is because you completely ignore and disregard the action verb in the question. And it is very important that you comply with the requirement of the examiner. So, how do we get to know the expectations of the examiner? That is by reading the action verb. Advise. What do you mean by advise? And there is attached to the exam paper is another paper where the action verbs are defined, interpreted, and you can go through the definitions of action verbs and you can see what the examiner's expectations are. So, when the examiner requires us to advise, what do you think he wants us to do? He wants us to provide instructions or precautionary measures. So, you need to decide how your answer should be and design your answer in such a way that you provide required instructions, you provide required precautionary measures or the instructions to the entity concerned. So, that is Tesla Energy Private Limited in this question. Now, especially for questions like SME, you can in most of the cases take the answer from the book. You have to carry that book to the exam hall. We have the SLFRS for SME, and you can go to the relevant section and you can just go through the relevant sections and find out what you can include into the contents of your answer. What do they talk about? It says the going concern issues are noted. A director has inquired accountant of TE whether any issue on going concern should be disclosed even though the entity prepares its financial statements in accordance with SLFRs for SMEs. Now, whether it is an entity for which we apply full SLFRs or an entity for which we apply SLFRs for SMEs, you need to disclose the required disclosure requirements need to be made in the financial statements of the entity irrespective of whether it is an entity for which SME SLFRs applies or full SLFRs applies. So, what does the standard for SLFR, what does the standard SLFRs standard for SME say? Now, there are some indications that will cast a significant doubt on the ability of being able to continue the operations into the foreseeable future. And if certain doubts, certain indications will be apparent, that will cause certain uncertainties or doubts as to the possibility of being able to continue into the foreseeable future. So, without keeping those facts to yourself, you need to disclose them in the financial statements, financial reporting of the entity concerned. Now, the standard says you need to disclose the fact that there are certain uncertainties that are significant and they cast a doubt on the ability of continuing into the foreseeable future, and you need to make that disclosure. And you need to also disclose on what basis the financial statements have been prepared. Now, we know if we apply the going concern principle, you know how the financial statement should be prepared. If you apply the going concern principle, your financial statement should be prepared in a way that you need to impress the readers of the financial statements that this business will continue for a foreseeable future. But if the going concern principle does not apply, you need to adopt a different approach, and you need to apply a different basis, and you need to explain what that basis is. Also, you need to explain the reasons for changing the basis of preparing. You need to explain the reasons for using a different basis to prepare financial statements. So, those are the requirements of disclosures under going concern of the SLFRs for SME, and you can see the question given in the answer says, if the directors of Tesla Energy Private Limited makes an assessment of the going concern, the directors management become aware of material uncertainties related to events or conditions. If the management has cast significant doubt on the entity's ability to continue as a going concern, the directors management shall disclose such uncertainties relating to the going concern of the entity in the financial statements for the year end. This is a requirement in SLFRs for SME. If the entity determines that the financial statements cannot be prepared on a going concern basis, it shall disclose that fact together with the basis on which the financial statements were prepared and the reasons why the entity is not regarded as a going concern. So, that is the answer, and that is what I explained now. We will move on to part B of the question. Solid Star PLC is in the process of finalizing its financial statements for the year ended 31st March 19. The following issue has not yet been resolved. During the year, SSP introduced 2 retirement benefit schemes to its employees, details of which are given below. Scheme 1. This is a retirement benefit plan for employees where SSP and its employees have to contribute 8% and 12% of annual salaries respectively. These contributions will be invested in plan assets. Under this scheme, employees are entitled to a specific proportion of such plan assets at retirement. This in turn depends on the performance of investments. Scheme 2. This is also a retirement benefit plan where SSP and its employees have to contribute 10% and 15% of annual salaries respectively. These contributions will be invested in plan assets. The amount of the retirement benefit paid to retirees is determined by referring to their period of service. If the plan does not have sufficient funds to meet the retirement benefit liability, SSP is obliged to fund the shortfall. Required, advise the management of SSP on the following: classification of the above retirement benefit schemes as per case 19 employee benefits. Number 2, the accounting treatment to be used for the retirement benefit schemes. Right. Now the question is from LCase 19, that is pretty clear. And first you need to understand which category these schemes fall into, and both of them are retirement benefit plans, and it is quite clear and obvious that both of them fall into post employment benefit plans. So it is the post employment benefit plans which we further bifurcate into 2, like defined contribution plans and defined benefit plans. And so that is very important you understand how these 2 schemes, benefit schemes, are differentiated from each other. That is where the problem lies. Now let me take a simple example, just without parachuting to the answer all of a sudden, just to give you a small briefing on how these 2 can be separately identified. Defined contribution plan. Defined contribution plan. The name given itself explains what it is without getting someone else to explain. If you just go through the name given, that itself explains what it is. Now say for an example, if you recruit an employee with a salary of 100,000 rupees, and if salary will be deducted by 10% for EPF, internal fund, and the employer is supposed to contribute by 15%, altogether 25,000 should be remitted to a separate fund entity, and to this fund the employer should keep remitting 25,000 rupees every month, every year, as long as this employee works. Eventually, when this employee retires or attains to the retiring age, or when the employment contracts are terminated, the amount that this employee can draw from the fund is not only the contributions made by the employer, also can draw the amounts which the fund has generated from the investment of the funds elsewhere. The contributions to the funds will be invested elsewhere, so that the participants of this plan can draw not only the contributions frequently made, also the income this fund has created and generated for the participants by investing the funds elsewhere. So, as a result, the return from the fund will be from two sources. What are the two sources? From the contributions from the employee and from the income of investments of the fund elsewhere. Now, does the employer or the employee know how much of benefits he can draw eventually, either when the employee resigns the company or when the employment contracts are terminated? So, nobody knows about it, and everyone is clueless about it, and no one knows what the eventual benefits amounts will be. But that is not how you explain and describe, define a defined contribution plan. Now, the employer has to contribute 25,000 rupees a month, and when the employer, after the employer contributed all what he was supposed to contribute, the employer does not accompany any more constructive or legal obligations to the fund, does not accompany any constructive or legal obligations whatsoever. Once the employer has contributed all what he was supposed to contribute to the fund, and the employer does not accompany any more liabilities, obligations, constructive or legal whatsoever, and that's it, the employer will be relieved from, he does not have any other burdens, he will be relieved from all the burdens, and this is what he was supposed to do. And if there is a liability for the employer, and that will be only to the extent of unremitted contributions, remittances to the fund. Just imagine the employer being liable to contribute 25,000 rupees a month, and the employer kept remitting 25 in all the months, but in the last month he got stuck in finance and he could not remit the last month remittance to the fund, and that is what he will be liable up to. The employer will be liable only up to the amount of unremitted contributions, that is it. But see, if you promise to an employee to pay an amount of benefit which is equal to an amount which is determined based on the length of the service. Now, say for an example, if somebody works over 5 years' time and the employer has promised to pay such amount of benefit which is equal to the amount of salaries of a month into the number of years of service worked. Just imagine the employee drawing 500,000 rupees salary a month, and if he has worked for 10 years altogether, the benefit amount to be paid should be 5 million rupees. Then we have defined not the periodic contribution, we have defined and fixed the final benefit amount. Now, not like the previous defined contribution plan, here once and for all we have set and defined and fixed the final benefit amount. You need to design, you need to decide, you need to fix, you need to calculate the periodic remittances in such a way that you can meet up this requirement of paying 5 million rupees to the employee by the time he leaves the company. So, at any given time, the amount of provisions, amount of liability to be paid to him should be equal to the amount of salary of a month into the number of years of service. So, here without you fixing and contributing the periodic contribution, once and for all we have set the final benefit amount. So, you need to decide, calculate the amount of contributions periodically in such a way that we can meet up this expected value of 5 million rupees. Just in case the employer has kept remitting to the fund an amount that he thought would be enough to meet up the requirement of 5 million rupees, but then we have only 4.5 million rupees in the fund. We have only 4.5 million rupees in the fund, and the employer can't just pay 4.5 million rupees and wash his hands. He has his obligation to an amount of 5 million rupees. So, even after contributing all what the employer thought would be sufficient to pay off 5 million rupees, still the employer accompanies some more liabilities in a defined benefit plan. So, how do we define or explain and describe a defined benefit plan? An employer has further obligations to a plan even after contributing all the contributions that he was supposed to contribute, still the employer accompanies some more liabilities. So, that is the prominent features of a defined benefit plan, and that is what you need to remember. So, apply that knowledge here, and then you can easily understand how you can identify what these benefit plans are. Scheme 1, this is a retirement benefit plan for employees where SSP and its employees have to contribute 8% and 12% of his annual salaries respectively. These contributions will be invested in plan assets. Under this scheme, employees are entitled to a specific proportion of such plan assets at retirement. This in turn depends on the performance of investment. Nowhere the explanations and the descriptions, nowhere does the explanations and the description of the scheme say that the employer is having a constructive or a legal obligation towards the plan even after contributing all what the employee is supposed to contribute. Does not say. So, as a result, the employer is not deemed to have further constructive or legal obligations to the fund after contributing, after remitting all what he was supposed to contribute. So, then simply you come to the conclusion that scheme 1 is a defined contribution plan. Scheme 2, this is also a retirement benefit plan where SSP and its employees have to contribute 10% and 15% of annual salaries respectively. These contributions will be invested in the plan assets. The amount of the retirement benefit paid to retirees is determined by referring to their period of service. If the plan does not have sufficient funds to meet the retirement benefit liability, SSP is obliged to fund the shortfall. Now, what it says is different to what you heard right now in scheme number 1. It says clearly that the employer has to contribute by 15, employee has to contribute by 10%, but if there will be a shortfall in the fund to the promised amount of benefit, if there is a shortfall in the fund to pay the promised amount of benefit, and the employer has the obligation to fill that gap. He has to bridge the gap, and then this is a defined benefit plan. So, that is the main important point that draws a line demarcating defined contribution plans from defined benefit plans, the employer having further obligations to the plan even after contributing the required contributions as promised. So, you can look at the answers. Scheme 1 is a defined contribution plan because employees are entitled to a specified proportions of the plan assets and depend on the performance of the investment. So, therefore, Solid Star PLC does not have further obligations other than the amount contributed to the plan. The contribution paid by SSP should be recognized as an expenditure. Scheme number 2, This is defined, this is a defined benefit plan, since SSP is obliged to fund the shortfall if the plan does not have sufficient funds to meet the pension liability. LCAS 19 requires defined obligations net of the plan, net of the fair value of the plan assets to be recognized as a liability in the financial statements, while the movements are recognized in profit or loss and other comprehensive income. Right, so that is the answer given. Now they are asking the classification part of it plus the accounting treatment. Now in a defined contribution plan, the accounting part is not so complicated. What you simply do is you take the contributions of the employer, employer's contribution should be taken to an expenditure, and that is the current service cost, as you know. Simply the contributions of the employer should be expensed as and when you receive the service of the employee. So the benefit amount for which the employer contributes should be expensed during the period, expense for the period during which the employer receives the related services from the employee. And the accounting for a defined benefit plan will be little complicated. Why? Because here LCAS 19 says that you need to recognize the movements of a defined benefit liability or an asset partly to profit and loss and partly to OCI. How does a defined benefit obligations or a defined benefit asset changes, moves? You know, we have different items. Current service cost has to be taken to profit and loss. There can also be past service cost is also taken to profit and loss, and there can be net interest cost is also taken to profit and loss. And then if there is net actuarial gains and losses, remeasurement differences should be recognized to OCI, not to profit and loss, and net benefit liability or net benefit asset should be recognized to the statement of financial position. So that has to be your answer for Roman simple number 2 of part B of question number 2. Question number 3. Part A. Some financial instruments contain elements of both liability and equity. Example, LCAS 32 financial instruments presentation requires segregating these two elements and disclosing them separately. Required, explain the reasons for separately identifying liability and equity elements of compound instruments. Now a compound instrument can be explained in two different perspectives. Say we are issuing 5 million worth of a bond at the coupon rate of 5%, when the market interest rate of a similar bond has 12% interest rate without the conversion option. So we have given an option to receive 500,000 shares of the company in lieu of the settlement of the bond in cash. Now, here, as we studied before in financial instruments videos, this is including part of equity and part of liabilities. You can explain that in terms of conceptual framework as well. And this is a 3-year bond and you are supposed to pay the coupon annually. So you take the first year coupon 250,000 payment, second year payment 250, and the last year payment 5,250,000. You have a contractual you have a contractual obligation to deliver these cash flows over the maturity period. And for that to be a liability, it has to be a present obligation. To calculate the present obligations, you need to transform them to the present values. But as you transform them to the present value, you can't just use another interest rate. You also have to calculate the fair value of the liability. Why? This is a financial liability. Financial liabilities are measured at fair value. So, in accordance with SLFRS 13, we not only calculate just the present value, also you need to calculate the fair value. To make the present value equal to fair value, you should discount it by the market interest rate. Market interest rate, that is one interpretation. And if the fair value of the liability, in other words the present value of the liability, let me take a random figure, say 4,250,000, you need not to calculate. If that is the value of the liability, then again you can apply the definition of equity items in the conceptual framework. What does it say? An equity should be the residual interest of assets after deducting all its liabilities. Now, from the bond issue we have received altogether 5 million, that is the asset amount. And you deduct all its liabilities, liabilities are 4,250,000. And the residual interest seems to be how much? 750,000, 750. Unless you do this split, unless you do this breakdown, it's a complete breach of the conceptual framework and there is a mistake. Unless you do it, if you recognize the entire amount of 5 million rupees under liability, that erroneous accounting can have a significant impact on your gearing. Why? You recognize the entire amount of 5 million rupees under debt, which would have otherwise been recognized partly under equity and partly under debt. So, your gearing position increases, and that part is not so important in the answer, but you should know. So, one reason for us to do is because we have a common instruments in which we get both equity components and liability components. And the another interpretation can be given. We can give another interpretation. To the bond holders we have given an option either to receive 5 million rupees in 3 years or to receive 500,000 shares in 3 years time. And there is an embedded derivative of, there is an embedded share option derivative. So, that is like we issuing a debt instrument to which an option contract is also attached, embedded. Now, you need to apply SLFRS 9 to see whether these host contract and the embedded derivative need to be separated. You need to apply the criteria. What are the criteria? If the entire instrument is measured at fair value through profit and loss, you need not to separate. And make sure it is not measured at fair value through profit and loss. It is not measured at fair value through profit and loss. Yes, the first requirement is satisfied. Second, make sure this includes the characteristics of a derivative. Yes, it includes the characteristics of a derivative. Then the third one, most importantly, must make sure that the economic characteristics of the embedded derivative can be different from the economic characteristics of the host contract. What is the host contract? The debt instrument, the bond. What is the embedded derivative? Share option contract. Now, the share option contract has equity features, whereas the liability character, the host contract has liability characteristics. How do we know? Now, if you look at the embedded option contract, it is a contract, derivative contract, which is to be settled by issuing a fixed number of shares against a fixed amount of cash. Fixed amount of cash is already received 5 million, and we are supposed to settle it by issuing fixed number of ordinary shares. If you just go to the fourth definitions under financial liabilities, you can just note it down. You can notice it. So, if it is a derivative instrument which is to be settled by issuing a fixed number of our own equity shares against a fixed amount of cash, the derivative has to be recognized an equity. So, the derivative has equity features, whereas the liability has, the host contract has liability features. If the host contract and the derivative contract have economic characteristics that are different from each other, you need to separate. So, once again you arrive and conclude that these two need to be separated from each other. So, you can explain either way. You need not to use either, but either you can explain that you need to recognize equity component and liability component based on the conceptual framework, or you can apply IFRS 9 to say that there is a hidden derivative, embedded derivative, of which economic characteristics are clearly different and distinct from the economic characteristics of the host contract. As a result, the separation will be required, and let us look at the answer. A compound financial instrument creates a primary financial liability for the issuer and grants an option to the holder of the instrument to convert it into an equity instrument of the issuer. In substance, the issue of convertible debt is equivalent to the issue of conventional debt plus a warranty to acquire shares in the future. The reasoning behind this approach is that an entity's equity is its residual interest in its assets after deducting all of its liabilities. Therefore, to reflect the economic substance of the instrument, it is important to recognize, measure and disclose debt and equity components separately, which makes financial information provided to the users more relevant. So, they have the suggested solution applies the host contract and the derivative contract approach. Then part B. Dreamlight PLC issued 200,000 convertible bonds on 31st March 18. The bonds have a 3-year term and are issued at par with a face value of 1000 rupees per bond. Given total proceeds of 200 million rupees, interest is payable annually at a nominal annual rate of 6%. Each bond is convertible up to maturity into 500 ordinary shares. At any time when the bonds were issued, the prevailing market interest rate for a similar bond without the conversion option was 9%. So, what is the requirement? Calculate the value of the equity component in the bond. Advise Dreamlight PLC as to how the above bond should be presented in financial statements based on the calculations one above. As at 31st March 18, the 2 years after issuing the bonds, Dreamlight PLC found that there is a less likelihood of exercising conversion options. Explain whether the presentation of the above bonds would be changed in the 3rd year. Right. So, we have to do the calculations to find out equity component and the liability component. So, let us take the cash flows 200,000 convertible bonds, 3-year term, face value is 1000 rupees per bond, total proceeds 200,000, coupon is 6% and the market rate is 9%. Let me work out on coupon interest payment. Let me show the figures in thousand. 200,000 into 6%, this is 12,000, and this is 212,000. To calculate the fair value of the liability, you should discount these future cash flows by the market interest rate of a similar instrument without the conversion options. We learn it also from SLFRS 13, 1.09, 1.09 to the power 2, 1.09 to the power 3. 12,000 divided by 1.09, 11,009. This is 10,100. $163,703. Take the total 11,009. This is 10,100 plus 163,703. So it is 184,812. This is the fair value of the liability. Fair value of the liability. Then take the proceeds of the bond. Proceeds were 200,000 and then equity component. Equity component. Equity component should be 15,188. So it is 15,187,768. The suggested solution shows the totals not in thousand. Then the accounting part of it, you need to see how the accounting part is done. They want us to explain in the questions, in the requirements, they want us to calculate the value. So if it is the calculation, you need not to do anything else, just only the calculations. This is what the examiner expects. Don't write anything, and you need not to please the examiner by supplementing additional explanations, and that you won't get marks. Advise Dreamlight PLC as to how the above bonds should be presented in the financial statements based on the calculations. So we did the bond issue when the bond issue was on 31st March 2018, and they want us to show how we do the accounting in the financial statements on 31st March 18. Just a simple double entry accounting here. You can debit cash by 200,000, credit equity by 15,188, 15,188, credit liability by 184,812, and this is your simple accounting, double entry accounting. That is second part of the question for 3 marks. Then 2 years after issuing the bonds, Dreamlight PLC found that there is less likelihood of exercising conversion options. Explain whether the presentation of the above bonds would be changed in the 3rd year. And let me do a simple double entry account. This part is not needed at the exam, but I will do it just to make it more clear in understanding. Now you recognize the liability 184,812, and if you see how this is classified under financial liability, this is under other financial liabilities. Initial measurement is fair value, subsequent measurement should be amortized cost. Amortized cost is calculated using effective interest rate. So, which interest rate should we use as the effective? That is 9% market interest rate. Since there was no transaction cost, you can make use of the market interest rate as the effective interest rate. So, let me work out 184,812 into 9%. We should recognize to profit and loss 16,633, and you need to go on paying the coupon cash. It was 12,000 here, and if you close it up, this is 5, this is 4, this is 4, 1, this is 0, 2, 201, 445, 445, this is 9, 189,000, 189,445. And remember, this part is not needed. I am just telling you this part is not needed, and I am doing this to make it clear. I want you to understand how we do the accounting at the end, at the maturity. So, 189,445 into effective interest, which should go to profit and loss 17,050, and you should pay your coupon 12,000, and let us calculate the amortized cost end of the second year. This is 5, this is 9, this is 4, this is 6, this is 0, 206, 206, 495, 495, this is 4, this is 9, 194, 194, 495. Let us calculate once again. Effective interest, that is 17,505, and you should pay your coupon cash 12,000. 0, 0, 0, this is 2, this is 1, 212,000, 212,000, closing balance should be 200,000. We are now on the maturity, at the maturity now. Now the lenders, investors into our bond can have an option. So, what is the option? Either they can request the bond be redeemed in cash. So, we are prepared if the lenders, our investors prefer the redemption to be done in cash, we can simply credit cash and debit to liability account. And if our lenders prefer the redemption to be done by converting that into ordinary shares, and then simply what you do is you debit to liability account and credit to share capital of our company. Now, the question says, towards the end of the second year, the bondholders are very much likely of preferring the settlement of the bond in shares. They want us to do the redemption in shares. Now, whether, irrespective of whether the bondholders prefer the redemption in cash or the redemption in shares, your accounting need not to be changed. It is only just that you debit to liability and credit to cash if the settlement is done in cash, or if they prefer the settlement in shares, it is just a matter of you debiting liability and credit into share capitals. That is it. And here, depending on how the lenders want us to do the settlement, your accounting need not to be revised halfway through. So, that should be the answer for that part, and let us see what the examiner says. even if there are changes in the likelihood of the option being exercised, the split between the liability and equity components remain the same throughout the term of the instrument. This is because it is not always possible to predict how a holder will behave. The issuer continues to have an obligation to make future payments until the conversion, maturity of the instruments or some other relevant transactions take place. That is the answer for part, the last part of the question number 3. Then we will quickly move on to question number 6, console question, and that carries altogether 20 marks. Pencil PLC is a large public limited company based in Sri Lanka. It has shareholding in 2 other companies, Sun Grain PLC and Albion PLC. Statements of financial positions as of 31st March 19 are given below for all 3 companies. Assets, non-current assets, property, plant and equipment, investments, current assets, inventories, trade and other receivables, cash and cash equivalent, total assets, equity and liabilities, equity, stated capital, retained earnings, non-current liabilities, deferred tax liabilities, interest bearing borrowings, current liabilities, trade and other payables, bank overdraft. The following information is to be taken into account insofar as it is relevant. Pencil bought 80 million out of the 100 million ordinary shares in Sun on 1st April 18, exactly 1 year before, that was 80%. So, then Sun Limited becomes a subsidiary company within the group. Why? It has been an acquisition of 80%. The consideration consisted of an immediate cash payment of 60 million rupees together with deferred payment of 40 million due on 1st April 2021. The immediate cash payment of 60 million has been recorded under investment, but deferred payment has not been accounted for. Pencil's cost of capital is estimated to be 10%. So, before we read the balance part of the questions, we will write up the balance sheet format and we will get on with the required calculations right now. Assets, non-current assets, property, plant and equipment, goodwill. So, we will keep some space, current assets, inventories, trade and other receivables, cash and cash equivalent, total assets, ordinary share capital, consolidated retained earnings, non-controlling interest, non-current liabilities, current liabilities. Remember and make sure you are not using abbreviations at the exam, you need to write the full words. You cannot write the abbreviations and you need to write the full words, and if you get used to writing abbreviations, and those bad habits will be there in the exam as well. We will open up the required calculations. We will open up the cost of control for the goodwill calculation, non-controlling interest, consolidated retained earnings, and subsidiary companies retained earnings, that is Sun PLC retained earnings. To get started off, let me take the required balances now. Parent company has retained earnings of 125, let me take it to consolidated retained earning. Subsidiary company has a profit figure of 20, let us take it to their account. Right. And 80% acquisition, consideration consisted of immediate cash payment of 60 million, and let me bring that the figures are in thousand. Investment is 60,000. We will credit investment and debit cost of control. Deferred payment of 40 million on 1st April 2021. So that the acquisition was on 1st April 18. So that is due in how many years time? 19, 20, 21. Altogether, 1st April 18 acquisition date, 31st March 19, 31st March 20 and 31st March 21, 3 years. Let us work it out. We will work out 40 million, take the cost of capital 10%, it is divided by 1.1 to the power 3. 40,000, 1.1 to the power 3, it is 30,000, 052.6, and that is the fair value of the deferred consideration. So, on one hand it is going to be part of the investment, on the other hand it is going to be a financial liability, because the entity, the parent, has a contractual obligation to deliver cash to the previous owners. Deferred consideration 30,000, 052.6, and let me bring it to the balance sheet with interest of 1 year's time. So, this has to accrue interest at 1 year, interest at 10% for 1 year. So, even if you apply SLFR is 9, this is under other financial liability category, should be measured at amortized cost. Effective rate has to be 10%. How much? It has to be 3005.2, then will recognize interest of 3005.2, say finance charge on deferred consideration, and this liability has to be taken to the balance sheet. It should be 33,057.8. On the current, rather non-current liabilities, say deferred consideration liability. What is the value? 33,057.8. Then second adjustment, at the date of acquiring Sun, the fair value of its land and buildings was considered to be 10 million rather more than the value in Sun statements of financial positions. We will recognize fair value reserve 10,000. Also we will bring that to property, plant and equipment 10,000. And we will work out on additional depreciation on the fair valuation. Sun had acquired the property in April 8, and the building element comprising 50% is depreciated on cost over 50 years. By the time the business combination took place, these properties are 10 years old. Purchased on 1st April 8, business combination took place on 1st April 2018, so altogether 10 years, and these assets have 50 years lifetime. Out of 50 years, 10 years have passed by, remaining lifetime is another 40 years. So you need to depreciate this additionally recognized amount on the acquisition date over the remaining 40 years lifetime, but it is not the full amount which you should depreciate, it is only just 50%. Why? Out of the total amount, only the 50% is attributable to the building element which should be depreciated. So then 10,000 into 50% is 5,000 divided by 40 into 1 year, and 5,000 divided by 40 into 1 is 125. Let us recognize that into the books now. PPE should be deducted by 125 and we will debit that to subsidiary companies retained earnings 125, depreciation on fair valuation 125. Further, Sun's investments carried at 30 million had a fair value of 32. Subsidiary company also has investments 30,000. It was also revalued to 32 million. We will recognize fair value reserve on investments 2,000. The value of the investments had not changed since the acquisition. The disposal gain on the investment is liable for income tax at 10% capital gain tax rate. Disposal gain of the building is taxed at the rate applicable to the company. Disposal gain on land is liable for income tax at 10% capital gain tax rate. Consider deferred tax implications, if any, from the above adjustments. So we will recognize deferred tax adjustments, deferred tax, right. Normal income tax rate is given at 40%. So then disposal gain on investments is liable for income tax at 10% capital gain tax rate. So on investments fair valuation of 2,000, will recognize 10% deferred tax, that is 200 deferred tax liability, And also you should recognize deferred taxes on disposal gain on land is liable for income tax rate at 10% capital gain. Total property, plant and equipment fair value gain was 10,000, 50% is attributable to land element, will recognize a deferred tax liability on fair valuation of land at 10% and the balance 5,000 is attributable to building. There you should recognize deferred tax at 40%, not at 10%. So then 5,000 into 40% is 2,000. There you recognize a deferred tax liability of 2,000. Total deferred tax liability on the recognition date should be 2,700. Let me debit to cost of control. Deferred tax liability 2,700 and let me bring it to non-current liabilities. Deferred tax liabilities 2,700. Third, adjustment group accounting policies to value non-controlling interest at fair value as at the date of acquisition and goodwill to be calculated accordingly on 1st April 18. The non-controlling interest in Sun was fair value to 15 million. Non-controlling interest 15 million, debit cost of control, credit to non-controlling interest 15,000. The management assessed that 20% of the value of goodwill in Sun was impaired as of 31st March 90. Let us do that after completing the goodwill calculations and let me complete the goodwill now. Share capital of Sun 75,000. Then the retained earnings on the acquisition date. The retained earnings were as follows on the respective acquisition date. Sun 12 million. So, let me bring 12 million to cost of control, debit to subsidiary companies retained earnings, cost of control. Will then complete the goodwill 60,000 plus 30,052.6 plus 2,007 plus 15,000, 107 752.6, 107 752.6 goodwill. Let us take the goodwill 12,000 minus 75,000 minus 12,000. Goodwill has to be 8,752.6, 8,752.6, and there was a goodwill impairment. It was 20% of the goodwill has impaired 1,750.52. Will debit that to subsidiary companies retained earnings 1,750.52, goodwill impairment. Then adjustment number 4, Pencil bought 20 million out of the 50 million ordinary shares in Albion on 1st July 18, paying an amount of 30 million in cash for the shares. Let us look at the investors balance sheet. Investment is total 90 million, that is 60 plus 30, and let us see what the balance is. The investment has been correctly recorded at cost. Pencil exercises joint control over its investment in joint venture. So, this is going to be a joint venture for which we can apply still equity method. Let me open up another account, say investments in joint venture. Investments in joint venture, balance 30,000, will apply equity method. Number 5 adjustment, the stated capitals on Sun and Albion have not changed since their respective dates of acquisition. The retained earnings were as follows on the respective acquisition date. Sun has already been taken, Albion 8 million. Let us see the Albion's retained earnings by now on the reporting date, it is 15 million. So, we will recognize subsequent equity changes of Albion. Now, it is 15 million minus the retained earnings on the acquisition date into the percentage of acquisition. Into the percentage of acquisition, it should be 20 million out of 50 million, so the percentage should be 40%. 20 divided by 50 into 100 should be 40%. So, this into 40%. 15,000 minus 8,000 into 40% is 2008. Credit to consolidated retained earning, share of joint venture profits, and will debit to investment account 2,800, share of joint venture profits. Sixth adjustment, during the financial year ended 31st March 19, Sun sold goods to Pencil. Goods amounting to 8 million. These goods were sold inclusive of a markup of 25%. On cost, 40% of these goods remain in the stocks of Pencil at the reporting date. Since acquiring its holding in Albion, Pencil purchased 5 million of goods from Albion, which had cost Albion 4 million. All of these remain in inventory at the reporting date. Ignore the deferred tax implications, if any, from the above adjustments. Right. So, let us get on with the unrealized profit adjustment. Pencil bought the financial year ended 31st March 19, Sun sold goods to Pencil. The value of the goods has been 8 million. Unrealized profit calculations. Total value of the goods sold 8 million, 25% markup, 40% remains unsold, divided by 125 into 25, 8,000 into 40 divided by 125 into 25 is 667. It has to be 640. 640. Selling company was Sons, will debit to Sons retained earnings 640 unrealized profits, and will credit to inventories by 640. Pencil purchased 5 million of goods from Albion which had cost Albion 4 million. So, the unrealized profit has to be 1 million. All of these remain in inventory at the reporting date, ignore the deferred tax, right. So, we need to recognize unrealized profits between the investor and the associates 1 million into the group share. Investor share is 40%, it is 400. So, we will debit to consolidated retained earnings by 400 unrealized profits, and will deduct it from inventories 400. The buying company has been the investor Pencil. Seventh one, there was an intergroup balance of 45 million owed by Pencil to Sun at the year end. An amount of 3 million was owed by Pencil to Albion at the reporting date. Right now, the receivables are deducted by 5 million intercompany receivables. Trade payables are deducted by 5 million, but receivable from the joint venture cannot be counter cancelled. We can show it separately. 3 million receivable from the joint venture can be deducted from receivables and show it as separate item. Receivable from Albion 3000. So, then we can close up and complete the balance sheets. We will close up subsidiary companies' retained earnings. 20,000, 20,000 balancing figure. 125 minus 12,000 minus 1750.52 minus 640, 5,484.48. That into 80% should go to parent company. 4,387.58, 1,096.8. I will make it 9. Credit consolidated retained earnings by 4,387.58. Sun PLC retained earnings, credit NCI by 1096.9. Say Sun PLC retained earnings. Take the NCI figure 16,096.9. 16,096.9, 16,096.9 NCI, 16,096.9. Consolidated retained earnings 0.5, this is 7, this is 8, this is 1. One 782.38, 128 782 0.38. Investments in joint venture 32,800, and bring it to the balance sheet. Investment in joint ventures. $32,800. So, let us take the remaining figures from the balance sheet of Pencil and Son on line by line basis. Property, plant and equipment 200,000 plus 55,000. Take the total 255 plus 10,000 minus 125, 264,875. 8,752.6 goodwill minus 1,750.52. The remaining unimpaired goodwill is 7,002.08. Investment is 32,000. Inventories 44,000 plus 24,000. 44,000 plus 24,000. Minus 640 minus 400, 66,960. Trade and other receivables 38,000 plus 21,000. 21,000 minus 5,000 minus 3,000, it is 51,000. Cash and cash equivalent $6,000 plus 5,000, total 11,000. Ordinary share capital 180,000. Deferred tax liability 7,000 plus 4,000. Total deferred tax should be 7,000 plus 4,000 plus 2,700, 13,700. Interest bearing borrowings. Interest bearing borrowings 43,000 plus 20,000, 43 plus 20, 63,000. Current liabilities, trade and other payables 19,000 plus 16,000. 19,000 plus 16 minus 5 should be 30,000. Bank OD, bank overdraft is 4,000. So, the non-current assets 336,677.08, current assets 131,960, total assets 468,637.08, share capital 180, consolidated retained earnings 128,72.38, non-controlling interest taken, non-current liabilities 109,757.8, current liabilities are 34,000, balance sheet total 468,637.08.